Now on this, Dr. Pant, very good morning to you and thank you for speaking with us here at NDTV Profit.
Good morning, Samantha.
Good morning, ma'am. Just wanted to get your first sort of take on this. Now, a lot of interpretations of its impact in terms of how it will help the government's fiscal deficit targets, etc. But what is it telling us about the health of the RBI's own balance sheet and the economy? Let me start with your take on that.
Wonderful. You really put it very well. It shows you that the balance sheet of the Reserve Bank, which of course plays a very critical role in the functioning of the economy, is very, very healthy. And it's grown, and the RBI has minimized its expenses, and it is a big bumper surplus to give to the government. Now, as I can tell you that the RBI is the banker to the government, which of course you know, and it's also the debt manager of the government. To put the relationship between the RBI and the government very simply, for your viewers, let me say that it's like the relationship between a very stingy wife and a very extravagant husband who will always keep asking for funds. But when the funds are required, as in this case, for developmental functions, and development functions are very necessary to support national objectives, then the wife reaches under the mattress and coughs out. So how have we done that? We have got this bumper reserve because we have revaluation of our assets, foreign currency assets, gold, including gold deposits, gold held in India, which constitute about 72.34% of our total assets, and these have increased. Then there are our domestic assets, the penalties on banks and so on. And the increase on the asset side has been due to the rise in foreign investment, gold, loans and advances. And Tamanna, these are all audited accounts, which are as per the RBI.
Right. We also have R. Sivakumar, Head Corporate Strategy at Axis Mutual Fund, now joining in. Good morning, Mr. Sivakumar. It's a pleasant morning to be going into work, I'd imagine, with RBI's bonanza to the government with a 2.1 lakh crore dividend payout. What is this going to mean for the fixed income market? We did see yields dip below 7% yesterday, but do you feel like the next couple of days and weeks could continue to see M2M gains on debt portfolios?
Hi, good morning, everyone. And yes, obviously it's great news from a bond market perspective to get a large RBI dividend, and that the market will then look at this as a significant move in terms of fiscal consolidation. The government has, in its interim budget, already pegged a fairly, better than expected path of fiscal consolidation, and this will go some way towards, assuring, in some sense, that those objectives will be met. I think the larger message is that this greater than expected, it's almost twice as expected size of the dividend is definitely going to help the government meet its fiscal objectives. I will urge some caution in overinterpreting this because remember that this is only an interim budget, so we will get a final budget after the election, and so the bond market will wait for that to make up its mind about the trajectory of rates going forward.
And of course, the fiscal surprise will only be positive once we know where that money is going to be spent. But first up, on liquidity, do you feel like there could be an immediate impact on market liquidity after this bonanza?
Yeah, so one thing that we have observed in recent past is that liquidity has gotten tight as government coffers have gotten full, and the expenditure in some sense has been, shall we say, not forthcoming ahead of the election. And so you have seen some amount of liquidity getting tight. This move in itself does not change that because it essentially adds more to the government coffers. So we will have to wait for government to start spending to have an immediate or a decently large impact on the liquidity in the system. But we do expect to see that over a period of time, though may not be in the next couple of weeks.
Siva, hi, Neeraj here, good morning. Good time to load on to bond portfolios. The debate around rate cuts may continue, but this, at least on the Indian side, this gives comfort on the glide path for sure.
I think it does, Neeraj.
I think we've lost Sivakumar. Okay, we'll try and get that back. Dr. Pant is with us as well. Dr. Pant, lovely comment, by the way. This is Neeraj here. Good morning. Lovely comment at the start about how you set up the trajectory. Just one question, though. Did anything in that announcement surprise you at all, or Was this par for the course? Looking at the numbers that at the Reserve Bank per se.
No, not at all, because there is a provision for the RBI's contingency reserve. And Neeraj, this is absolutely something which happens every year, and it will vary according to the income of the RBI. It's in terms of the RBI Act Schedules 1934 and the audited accounts, and it gives a lot of money and elbow room for expansion and for scorching economic growth. So if we are going to be the second largest economy, then yes, we have to have a lot of money to spend, which the government now gets, and it is the due of the government.
Sorry. Okay.
And it will help the private sector because there will be no crowding out of expenditure. The expenditure the private sector need not put its expansion plans on hold because there is a lot of money, and the government may not restrict its infrastructure spend because there is a lot of money, which gives comfort to everybody every time.
Right. No, that's a fair call. While we're waiting for the elusive private capex to come forth in its true form, it hasn't quite done that thus far. Selectively, maybe, but not quite. Okay. Thanks for that point, Dr. Pant. Siva, you're back. We just lost you. I was just asking you if there's a good time to think of loading up on bond portfolios. Lots of events around the corner.
Yeah, but most of them positive. So I think we've been saying for some time that it is a good time to be invested in bonds. We are on the cusp of the index-related flows, this dividend. So I think from a bond market demand-supply perspective and overall, like I said, the fiscal consolidation path, the demand-supply characteristics sound good. More importantly, the inflation, especially core inflation, continues to remain low. And if food inflation catches up to core, I hope that happens, then we are looking at significant rate cuts. It may come delayed, but the path, I think the direction is right, even if we don't exactly know the path. So I think, yes, it is time to be loaded up on bonds at this point of time.
Siva, how immediate do you think you will see any impact of the RBI's decision? I mean, we've been talking about bond investments in a broader term for a while now. Do you think you're going to see any specific sort of activity or any new strategy basis this decision or this announcement yesterday? Does it really move the needle is essentially the question.
It does move the needle because it's a large amount. It does move the needle in terms of the fiscal situation. But like I said before, the point is to wait for the final budget and then take a call on this rather than wait for now. I think this gives, as Dr. Pant also just mentioned, this gives a lot of flexibility to the government in terms of planning its fiscal, especially the spending part, because they don't have to be as worried about the resourcing. And so that is what we'll be watching to see, and whether the government uses this extraordinary dividend to consolidate or whether they will use it to spend. And both are good choices. The question from a bond market perspective is which one will the government take? And so I think we'll have to wait until the final budget to take a sort of final call on the direction. But the path, I mean, like I said, the direction is more clear rather than the timing or the exact path, right? So it's only a matter of time. Now, I will also say that once all those risks are resolved, the yields won't be here. They will be significantly lower if everything pans out in this way. So you cannot wait for these events to pass before getting invested.
Yeah. No, so just to take that point further, if July is when things will become clearer on what essentially the government does with this money. Does it consolidate its fiscal deficit? Does it spend more? If it spends more, which is, I think, a possibility, you have a new term, you want to front load all of your infra, capex, etc. How would you see that?
I think the priority of the government very clearly in terms of capex, in terms of building infrastructure is very, very clear. And to the extent that this helps that process, the markets will not be upset, right? Usually when you look at the bond markets, they don't like it if it's so-called, poor quality spending, that is higher spending in current expenditure. But if you have a higher amount of spending in capital expenditure, I don't think the bond markets are going to be as upset, because it changes the potential GDP growth and therefore the fiscal metrics over a period of time. Because when you look at the key fiscal metrics such as debt to GDP ratio, if it increases the trajectory of GDP, that expenditure is not seen as a negative. So I think it's very important to see what path the government takes. I don't think bond markets will be upset either way. Of course, consolidation will be seen with very, very positively. But I think if the government goes for higher capex, the bond markets will probably be quite okay with that.
Siva, it's also Samina here, and I want to get your perspective on a couple of things. Since April, FPIs had almost taken a pause on front-loading ahead of India's inclusion in the JP Morgan bond index in June. Do you feel like this move could now help FPIs resume that front-loading, A? And B, while I completely take your point that duration is a good space to be in right now and looks attractive, but remember, we've been saying this or talking about this for the last 2 years now. Indian families, Indian HNIs have gone out and invested in duration over the last 8 to 12 months. Now, none of those portfolios are making any M2M gains. One thing aside, if you hold to maturity. Second, what I want to get from you is, if there is a bump up right now, would you recommend exiting these debt portfolios, or do you think it's better to wait it out for the next 8 to 12 months in anticipation maybe of a rate cut as well coming in from the RBI?
Yeah, I think that's a very important point. That in the recent past, we've not really seen a big move, and therefore, whoever have invested have largely made the equivalent of the yield on the portfolios or whatever, rather than any major capital gains. But you look at 2 years from where we started, 2 years ago, about this time, the 10-year yield was 760. So if you look at over the last 2 years, we've actually seen a decent-sized rally, and I think people don't appreciate that. That has happened during a period of rate hikes. So what then happens when rate cuts eventually start, right? So I think do not look at near-term, last 3 months, 6 months, 8 months, and then say that, I should be getting returns at every 3-month period. It doesn't work like that. You have to have a medium-term holding period. And as I've said in the last couple of years, when we had all the worries about geopolitics, when we've had all the worries about rising rates, we've still seen yields drop. So I think have a little bit of slightly, different perspective. I have a little bit of a different perspective on this. I think we're in for rate cuts, and therefore we should make money. Now, having said that, what are the risks? There are risks out there. We are seeing, continued pressure on geopolitics. We could see a resurgence of inflation if we have an extraordinary burst of growth pickup. So we should be aware that there are reasons for changing the portfolio stance, which are not related to this particular news, but rather would be, if we change our macro view. At this point of time, I'm not seeing those risks fructify, and therefore I feel confident in running longer duration.
Yeah. Thank you, Dr. Pali, and thank you, Siva, for joining us. That's good perspective coming in, so don't expect an immediate impact on market liquidity, but this is good news for the fixed income market. Duration continues to be an attractive investment opportunity for all our viewers who consider investing in debt markets as well. That's the implied Nifty. It's actually gotten better in the last couple of minutes of trade. Started off slightly lower now, 15-point higher is what we're expecting. We'll take a break. We'll come back. It is also the weekly Nifty expiry.